Some of the most expensive investing mistakes don't even sound reckless. They can sound completely responsible. Wait until the market settles down. Keep your money safe in cash. Watch your portfolio closely so you can sell before the next crash. These ideas feel smart because they promise control, but an overinflated sense of control can be one of the most dangerous pitfalls when it comes to investing. I'm Josiah Martin, certified financial planner professional, and today I'll break down 6 investing myths that sound intelligent but can quietly cost you years of progress. Let's start with the myth that gives people the ultimate illusion of control via sitting on the sidelines. The stock market is gambling. I won't invest because the stock market is just gambling. You hear this one everywhere, and honestly, it's easy to see why. Every day you see people trade high risk options, go all in on hyped up tech stocks, or chase meme trends hoping to double their money in a week. Those people are gambling, but that isn't true investing. Gambling is betting on a short term outcome where the odds are stacked against you. Investing is buying ownership in real productive businesses and giving them time to grow. There's a massive difference between buying a speculative stock because someone on TikTok said it's going to explode versus consistently buying a diversified index fund across thousands of companies. This past April, Warren Buffett put it well when he said, I compared the markets to a church with a casino attached. With a diversified portfolio, you have volatility. Your account will fall plenty of times. There will be recessions, crashes, and bad years, of course. But over the long run, it's historically gone up, and a lot. Look at this chart that I really like. It shows that if you hold the S&P 500 for one day, you essentially have a 50-50 odds of making money. Hold for 20 years and you've never lost. Short-term trading is a casino or a lottery ticket. Long-term investing is wealth building. So come into the church. It'll be good for you. Just do your best to avoid the temptation of the casino right next door. Myth number 2, stock picking will get you rich. Find the next Apple, spot the next Amazon, buy the future winner before everybody else catches on. The problem is that today's obvious winner usually wasn't obvious before it won. Once a company becomes successful, people can look backward and explain why it was inevitable. But that's so much easier said than done. And here's what makes stock picking so hard. You might think you have about a 50% chance of picking a stock that beats the market or loses to the market, right? That's how our brains think. Probably half outperform and half underperform. But the data shows your odds are way worse. Let's look at an academic research study done by Henrik Bessenbinder in 2018. His research found a majority of stocks do worse than 1 month treasury bills, which is essentially cash. And the best performing 4% of companies explain the entire net gain of the US stock market since 1926. Pretty amazing. It's called positive skew. There are a few tremendously big winners that provide monster returns. And if you miss out on those, you lag way behind the index. That's why stock picking is so difficult to do consistently, even for professionals. Now, this doesn't mean nobody can pick winning stocks, but it does mean a lot of luck is involved. Most investors would be much better off investing in diversified index funds. Instead of trying to identify that one future winner, you own a broad group of companies. Some will disappoint, some will disappear, and a small number likely will grow far more than expected. Jack Bogle, the founder of Vanguard, says, don't look for the needle in the haystack, just buy the haystack. Myth number 3, you should buy low and sell high. This sounds simple, but in practice, it turns into market timing. People say, the market looks too high right now. A recession is coming. I'll jump in after the next crash. Here's the trap. Market timing requires 2 perfect decisions. You have to know when to get out, and you have to know when to get back in. Imagine the market drops 20%. Do you buy now? Well, probably not, because the financial news will be saying it'll get way worse. What if it falls another 10%? Then it rebounds 15%. Do you buy the recovery or wait for another dip? There is never a green light on the news that says, the danger is over. It is now safe to invest. By the time the news feels good, prices have already surged and you missed out. For most investors, the best strategy is the boring one: invest regularly, stay diversified, and ignore the noise. Myth number 4: more trading means better results. Modern investing apps are engineered to make your portfolio feel like a video game that needs constant tinkering. A stock dropped 3%, maybe we should sell. An analyst changed a price target, maybe we should buy. What's counterintuitive is in almost every area of life, more effort yields better results. You practice more, you become a better musician. You train harder, you become a better athlete. But the harder you try to optimize your portfolio daily, the easier it is to ruin it with emotional trades and taxes. You should definitely check your account to make sure contributions are going through or to adjust for major life events. But the market had a red day today is not a life event. If you're tinkering with your portfolio too much, you're probably shooting yourself in the foot. Myth number 5: cash is always the safest option. Now, don't get me wrong, cash is essential. Your emergency fund belongs in a secure liquid account. Money you need for a down payment in the next year should not be in the stock market. But cash is useful is not the same as cash is safe. Cash protects you from short term market drops, but it leaves you defenseless against inflation. If you keep 50,000 in cash in a Bank of America savings account, earning 0.01 for the next 30 years, you'll still have roughly $50,000. But housing, food, and healthcare will now cost twice as much, probably. So you didn't lose dollars, but you lost half of what those dollars can buy. So keep in mind, safety depends on your goal. For an emergency next month, cash is perfectly safe and is ideal. For retirement 25 years away, cash is one of the riskiest assets you could hold. I'm a big fan of bucketing your spending needs, especially in retirement. For example, something like cash for the year ahead, high quality fixed income for 5+ years of spending to weather market downturns, and then equities or stock funds for the remainder to help stay ahead of inflation. Because let's be real, folks, inflation doesn't seem to be showing any signs of stopping anytime soon. Myth number 6: I'm young, so retirement can wait. When someone is 22 or even 32, retirement can seem like it's a whole nother lifetime. You're paying rent, student loans, trying to build an emergency fund. Retirement feels like the last of your concerns. And waiting a few years can feel harmless. But when you're young, your biggest investing advantage isn't your income, it's time. Let's use a simple hypothetical example. Suppose we have two people. We'll call them early Evelyn and later Lou. Evelyn starts investing at age 25 and invests 10,000 for 20 years, stopping at age 45. So she invested $200,000 total. Later, Lou starts at 45 and decides to be a bit more aggressive, saving 20,000 a year for 20 years until he's 65. So he invested 400,000. What's the outcome at age 65 if we assume an 8% return? Early Evelyn reaches age 65 with 2.3 million. Later Lou finishes with 988,000. Even though Lou had double the contributions, keep that in mind. The difference was that compounding simply had more time to work. So tell your kids, tell your grandkids to start early. Start small with whatever is possible. Get an employer match on the 401k and just build the habit, because you can't go back and buy another decade of compounding. So at the end of the day, successful investing comes down to a simple choice. Do you want to feel in control, or do you want to actually build wealth? And importantly, do you have the patience to let it work? So I urge you, break the cycle of instant gratification and control, build a plan that works, and let the markets and time do the heavy lifting. If this video resonated at all, leave a like, subscribe to the channel, and send this to someone who needs to hear it. Thanks for watching. I'm Josiah Martin, and I'll see you in the next video.